In this video, I'll be doing a Tesla stock analysis explaining 3 main reasons why I think Tesla stock is overvalued and not a good investment. Now, before Tesla investors get upset, since there's a lot of passionate Tesla bulls out there, I just want to say that I think Tesla is a great company and I think it's very well run. The only reason I don't think Tesla stock is a good investment is because it has a very pricey valuation for its revenue and earnings. So I don't think there's a realistic path for the company's share price to appreciate, since it already has a market cap valuation of over $750 billion and is one of the largest companies in the world. If you still disagree after watching the video and hearing my points about why I think Tesla stock is overvalued, leave a comment down below letting me know why you disagree, and I'd be happy to have a conversation. I'd love to hear your counterpoints. But without further ado, let's get into the Tesla stock analysis and talk about why I think it's overvalued, which will be divided into 3 main points. The first point I want to talk about is Tesla's revenue and valuation relative to other major car manufacturers. To illustrate this, let's take a look at Tesla's earnings from their first quarter in 2022. And look at the report to establish some numbers. We can see here from their earnings slide deck that they had total revenues of roughly $18.8 billion in the first quarter, which was a record high revenue number for the company, and they had a 19.2% operating profit margin on that revenue for a little over $3.6 billion in operating income. Keep in mind that Tesla stock is valued at $750 billion as a company. Now let's look at the second highest valued car company in the world, Toyota. In the same quarter ending in March 2022, they did nearly $280 billion in revenue, which is nearly 15 times the revenue that Tesla did in the same quarter of $18.8 billion. Toyota's operating income was a little over $20.7 billion, which is well over 5 times the operating income compared to Tesla's number of $3.6 billion. It is important to note that Tesla does have a higher operating profit margin at 19.2% than Toyota does, which only has roughly a 7.4% operating margin on its business. So if someday Tesla was selling $280 billion of cars a quarter, like Toyota is, they would be making more money than Toyota, since they would have a better operating margin and be making more profit on each car they sell. But here's the problem, and this is my main criticism of Tesla as an investment. Tesla stock is valued at around $750 billion as a company right now, and Toyota is only valued at around $260 billion. You heard that right. Tesla is valued at nearly 3 times higher than Toyota right now, even though Toyota is making over 5 times the amount of operating income. The current $750 billion Tesla valuation comes from the market assuming that it will be making significantly more money than Toyota in the near future. But the fact of the matter is that Tesla currently is not close to making the same amount of revenue or profit that other car companies do, like Toyota. So the fact that it's valued significantly higher than them makes me believe that the market is overvaluing Tesla by a large amount, and that Tesla stock will eventually have its valuation come down in line with its peers. Keep in mind that if Tesla was valued near the $260 billion mark, like Toyota, it would be trading closer to nearly a third of the current share price of $740 a share that it's trading at now. So you would have nearly a third of that. At one point last year, when Tesla crossed the $1 trillion market cap valuation for a while, Tesla was even valued higher than the top 5 rival automakers combined. Even if you do think that Tesla is a great company, like I do, it's hard to believe that that's a fair valuation for the company, and makes me think that Tesla's stock is way overvalued compared to its peers. The second main point I'd like to talk about is that Tesla has increasing competition from other car companies. Tesla definitely has the first mover advantage and has built somewhat of a moat for itself against other car companies, since it's been the leader in the electric vehicle space for a while. But now that electric vehicle sales are picking up, they're going to be facing increased competition from both major traditional car companies and electric vehicle startups like Rivian and others. According to Kelley Blue Book, Americans bought nearly twice as many electric cars in this first quarter of 2022 compared to the first quarter of 2021. About 75% of those cars were Teslas, with the Model Y and Model 3 taking first and second place, and Ford's electric Mustang coming in third. But they also note that the competition pool is expanding, with 18 different electric vehicle models being bought by Americans in the first quarter of 2021. Now there's 32 that are being bought in the first quarter of 2022. The competition's only increasing, with an estimate of nearly 50 electric vehicle options being available at the end of 2022. The point is that there's more risk to the downside than there is to the upside, in my opinion, for Tesla. They had 75% of the electric vehicle market share in the first quarter in the United States. But with the extra competition flooding the market, it seems more likely that their market share will slip from that dominant 75% level rather than taking even more market share. Because of the fact that they are the incumbent and lots of EV competition is being introduced by both traditional auto manufacturers and startup electric vehicle companies, it seems like the risks are skewed to the downside for Tesla, with it being hard to gain more market share and potentially being very easy to lose it to the competitors if they aren't careful. For this reason, I consider this a major risk to Tesla's stock that I don't think the stock market is taking as seriously as it should. In our current automobile market, there are a wide variety of car manufacturers instead of one dominant company. I think the electric vehicle space will be a similar situation, with market share getting fragmented between a lot of different car manufacturers, rather than one company controlling the market like Tesla. The third big reason I think that Tesla stock is overvalued is that their operating margins are higher than their peers, but their margins are not high for a tech company, which it is sometimes argued that it should be valued like to justify its current valuation. Take Apple, for example. It has a nearly 30.8% operating margin in the same quarter compared to Tesla's operating margin of 19.2%. Unless Tesla can expand its margins, it has operating margins on the lower end of tech companies, and yet it has a higher price-to-earnings ratio than companies like Apple that have higher margins and more earnings. Tesla has a price-to-earnings ratio of nearly 100, while Apple has a much more reasonable price-to-earnings ratio of around 24.5, even though it has higher operating margins and makes much more profit than Tesla. It seems unreasonable that Tesla is given such a high valuation premium as a company when its margins are low for the tech space. While it's true that it has high margins for a car company compared to others, the auto manufacturing industry is historically a very low margin industry, and it remains to be seen whether Tesla can maintain its high margins as electric vehicle competition starts to hit the market and its pricing will be forced to compete. Those are the three main points I wanted to cover in my Tesla stock analysis. I think it's a great company, like I've said, but a $750 billion valuation for a car manufacturer is a massive premium, and there's a lot of potential risks that could cause the stock price to fall. I would be happy to be an investor someday if I could buy shares at a reasonable valuation, but not at this high of a price relative to its earnings, since it seems like the market has priced Tesla for perfection, and the company has no room for error. If Tesla starts to lose market share or their margins get compressed, it will likely force a major correction to Tesla's stock price and condense its earnings multiple, which would cause the stock to re-rate significantly. This is similar to what we saw happen in Netflix, when it fell from nearly $700 a share to around $200 a share and has a PE below 20 now, after it became clear to investors that growing competition in the streaming space slowed the company's growth. If I had to make a Tesla stock prediction, I think that it will eventually have some sort of correction to a lower price to earnings ratio in the next few years once it becomes clear that competition's taking market share. In addition, I think there are near-term risks to Tesla's stock with Elon Musk being sued by Twitter. If for some reason he's forced to buy Twitter in October when the court hearings are, the stock market will likely push Tesla shares lower because his time will be divided by another additional company, which will leave him less time to focus on growing Tesla's business. But let me know what you think about this Tesla stock analysis. Do you agree with me that Tesla stock is overvalued, or do you think there's some factor I missed in this analysis that warrants the high valuation for the company? Let me know your thoughts in the comments below, and be sure to subscribe to the channel for more finance content. Thanks.